And we're live for Behind the Markets. And this is I'm your host Munyuma Mutwale. I'm here with your co-host as well. I think I've now put you as co-host. My mistake, man. My mistake. Just took over the entry show. And yes, my name is Munyuma Mutwale, and this I am with Mr. Vernon Chitifi, and we are going to be going through your 8 hours onwards news and analysis of how your investment markets and how your asset markets are doing as a whole. Good morning to you, Vernon, and how are you doing?
I'm doing great. Thank you so very much. How is the day so far? It's only it's barely midday.
It's the start of the day, but it feels like it. I mean, we've both been up and working for quite some time now. I mean, you start your day somewhere around 5:30. That's how we both get kicked off, right? Right. So it's time to get through what the early parts of our market are looking like. So thank you to everyone, and let's get going. FX market's still in a downturn. We have not changed position yet. The Kwacha lost 0.14% yesterday, and we saw it start trading on the interbank rate at 19.2669, and that's where we are now. We're still about 6.4% down year to date. As of the current holdings and where we are as a position, we're also seeing the rand held its position yesterday, so we are seeing that the rand, but it did actually sell off by a little bit by zero. The rand went up by 0.27%. So we did see the rand have a little bit of a stronger day. Sorry, the previous day was a little bit of a sell off. And we've seen that the rand year to date is up 2.47%. So Kwacha is having a little bit, still having that sell off period. It's still losing quite a bit of its momentum. And obviously, we still haven't gotten out of our concerns regarding our debt. We haven't managed to get through our negotiations as a country. Now, what we're seeing so far is we're on day 88, consecutive days of the kwacha losing value against the United States dollar. 88 consecutive days, and currently the US dollar is sitting at a 52-week high. So these are still startling numbers that we're still trying to get through as a country. Now, we did see yesterday the stock market did perform a little bit positively. We saw Standard Chartered shares up by 1%, being one of the billion kwacha stocks. Whenever you see a billion kwacha stock move, you do see the index move with those billion kwacha stocks, unless two of them are in opposing forces. But they tend to be very strong weighted. One of the things that most people don't know about our stock market in terms of how it looks, about 80%, if not 88%, of our market capitalization is simply our billion kwacha stocks, the 8 stocks that have got a market capitalization of above a billion kwacha. In other words, they've got a market value of above a billion kwacha, and those 8 stocks basically make up 80%. Those 8 stocks make up about 80%, if not 88%, of the stock market index. If you remove Shoprite, remember Shoprite is just a company that's co-listed here, and we often tend to reflect the full value of Shoprite. But really, there's just a few shares here, about 2.7 million shares issued here for people to be able to invest in. So when you're looking at the stock market altogether, we have seen that it was up 0.05% yesterday, and on the week it's still down 0.31%. On the month, down 0.53%, and year to date down 1.42%. So we're still having a weak session on the stock market. We haven't seen anything really pick up in terms of rallying, but we remember we're still also waiting for annual data. We're still waiting for the data to come out in terms of the year-end reports. We have seen, obviously, Tanaka was the only one that actually has issued, because the banking sector should start. We should see some of the other banking sector also issue their financial statements. But in general, we are getting ready to start seeing a lot more of our listed companies around this month, around the second half of this month, going into the later part of the second half of this month, going into the earlier parts of March. That's when we should see the completion of most of the year-end results, and we'll be able to give you the financial scoreboard of how the year-end results are looking. But we still have to wait on how that's doing. Now, let's take a look at our bond market. Our bond market is still moving the exact same direction. So that secondary market bonds yesterday moved at about 0.1. Secondary bonds yesterday moved at about 0.1%. Right now, I was correct on that one. And we did see that the US dollar version of our bond market is still moving negatively. It still has persisted in moving negatively, down about 0.17% on the week, and still year to date 2.79%. So the bond market is still in negative territory. While taking a look at also our while also taking a look at our interest rates, we are seeing that GRZ bond interest rates were down 0.002% yesterday and still down 0.07. So in Kwacha, we actually do have a little bit of a bond rally here. It's just that the dollar perspective is actually taking down our bonds, and we've seen 30 days consecutive movement of GRZ bonds. So on the secondary market, bonds are doing pretty well. And then finally, let's go into our commodity market. Where do we stand? We saw copper down 0.07% yesterday, while oil was up 1.71%. Lots of oil bulls still playing the game because they are still on the group that China is back in the market, and they're still seeing that the Federal Reserve will start to lower rates. So therefore, oil will probably rally. Remember that oil companies do depend on good interest rates. So they are playing the game of the Fed continuing to raise interest rates, but pull back a little bit. We've seen gold up 0.08% yesterday. Some of the major news, in terms of risk assets such as your digital assets, being your crypto coins, they were down 1.49% yesterday, but still up 4.6%. But on the week, cryptocurrency is down 1.86% in terms of Bitcoin. Ethereum is down 0.68% on the week, but up 0.68% on the week, but down 1.66%. And if you're trading gold is up 0.94% from yesterday, but down 1.03% on the week in Kwacha. So you're seeing that your defensive assets are starting to turn around a little bit as risk-on sentiment starts to return. As we got into the first third of the month, what is the oil markets also telling us about our potential for the end of month movement? We are looking at a potential rate hike again, oil price hike that could possibly come in somewhere around 27.64. So prepare yourself, Vernon. I think there's an old song in The Lion King where Scar is singing, and he sings the words "Be prepared." So I would say that to as many people as possible. Be prepared. There's potential for this because oil prices are moving up positively this month. We have seen that with the Kwacha still losing value, we are also still seeing oil prices move up quite harshly. We've seen a Brent oil price shift downwards, yes, but we've seen a Kwacha move up 3.5%, and we've seen towards the tail end of it, oil prices starting to shift upwards because of risk-on sentiment globally. So altogether, what we are seeing is a market where we are seeing that inflation pressure is still alive in Zambia, with an FX rate that is still on the weakened point, with the oil sector that's potentially talking about a hike, and we're still seeing asset markets a little bit soft, especially risk markets are not doing too well. So your defensive assets are still your best play, but they're also starting to lose a little bit of momentum. So there is a time where everyone might take a bit of a knock on the broad side of it. Even your defensive assets may not do too well. So this is just a time to be well diversified so you can spread the loss. Okay, you don't want to be too concentrated into one area. This first couple of months of the year are not going to be too great, especially on your portfolios, until we start to see results coming in. So some of the news that's coming out today, Vernon, I am looking into it from a four horseman perspective. We did see, in terms of the different types of news that came in yesterday. I will be talking about later on a little article that did come out where we did an analysis on why are non-performing loans in banks at record levels, at record lows. Why do banks have only 5% of their loan output only sitting at non-performing when these are highly record levels? And we've seen that they just dropped from strong highs of 11, 12%. Just rate down to 5%. We'll talk about that later. We did see that yesterday. We did see U.S. Oil inventories were up by 2.4 million. That is going to push up barrels. That is supposed to push oil prices down, but it appears the oil optimists are still pushing up. In terms of other inflation news, paint company AkzoNobel was being interviewed yesterday, and they were actually stating that their supply chains are actually in better shape in 2023. So inflation through supply chains is actually slowing down. And they're saying that they've actually seen that quite well. So that was good news for anybody who's doing any global supply and any global trade. Global supply chains seem to be improving in that regard. Interest rates, we saw U.S. mortgages come down by 0.1%, 0.01%. Not enough, but it's still hovering around that 6.18%. However, the Federal Reserve did give a weak outlook to the economy. That's something that we should actually be paying attention to. The Federal Reserve did give a weak outlook to the economy, and therefore you may not be seeing risk on sentiment. The U.S. We also did see that the Fed is expected to continue to hike interest rates. And India came on the market yesterday saying they want to start factoring in environmental risk into lending. The Reserve Bank of India has issued rules on how to put climate risk into the financial system so that it can be quantified. And also impacted onto lending. These are practices, by the way, that we may find here in Zambia because we are getting a lot of climate-friendly funds that are going into our markets, specifically to support projects, specifically to support a few projects happening. Simultaneously, we are seeing that in terms of industrial news, we have seen that Tesla is still one of the top selling cars in California. Actually, Tesla was the number one selling car in California for another consecutive year, and we saw electric cars making 20% of all cars sold in California, which is one of the biggest markets. While we also saw that California obviously is 40% of U.S. EV sales. So that is some good news as well. And Italian retail sales did decline yesterday. So that data actually is affecting how markets are performing at the moment. So now how do we look in terms of what we're seeing of the four horsemen altogether? Inflation is starting to come down. Interest rates are persistent while potentially going both ways. Incomes are kind of held a little bit weak. And we are also seeing that the EV sector and also some industrial sectors are still going up. U.S. inventories were also up 0.1%, showing that there is a little bit of industrial growth in the market. So that is good for industrial growth. Remember that Zambia is going to be an industrially driven growth market. And that also shows that one of the top drivers of loan growth in Zambia, the 19% loan growth in Zambia in the banking sector, was loans to the manufacturing sector and loans to the mining sector. So remember, the three driving forces of loan growth and credit expansion in the country currently are manufacturing, mining, and mortgages. These are the three key drivers of growth in our credit sector, which seem to be the three key areas where we're probably going to see growth moving the fastest. So anything linked to those three, we're probably going to see moving faster than ever. Now, that is basically some of the data that we saw yesterday on the market. Now, to discuss some of this, one of the main stories that came out a few days ago, we did actually see a story regarding non-performing loans. And obviously, I'll get back into the conversation with Vernon very soon. But we did actually see a discussion coming out regarding non-performing loans and how are non-performing loans doing. So a story that we did publish a couple of days ago does say non-performing loans were sitting at record levels in terms of lows. Now, that story did confuse quite a number of people because it basically now set the perception that our financial system or our economy has actually engaged in a full-out recovery. Now, is our economy recovering? Yes, that is true. Our economy is starting to recover on a growth perspective. We are starting to see more investment coming in. We are starting to see more activity taking place. But however, we cannot start saying job done, victory, victory is our cry, because unfortunately some of this data may have got other components in it which we need to quickly work on. So if you take a look at, as I said, at non-performing loans, the data did show that for the last 2 years, we did see non-performing loans holding at a position of record lows of 5.8% in 2021 and 5% or 4.98% in 2022. Now that came off very close to record highs in 2020 when we saw non-performing loans sitting at 11.6%, only as high as 2017 and the only other higher than that was 14. So this was the data that we had in terms of non-performing loan data, and I think everyone can pick up on that very quickly as to what that means, what that meant for our banking sector and our economy. Now, this means that fragility in the financial sector is not as strong. This is what always kept the central bank from taking too much action. We had a fragile financial sector, which means that a lot of loans were going unprocessed. And we also now, a lot of loans were in problem sectors. So if the interest rates were raised, that could wash out quite a lot of people and could actually put a lot of danger into the system. So the central bank obviously kind of takes a step back. But if you take a look at your loan book, you did see now that, as I said, as it grew last year, non-performing loans didn't do too badly. Now, let's break down something into why. The question I think that is often asked, that was being asked of me and was being asked of a few of us, is why did this take place? So I want to share with you a little breakdown as to why are non-performing loans at record lows. So thank you to everyone who's with me. Let's go through this. Why are banking sector non-performing lows at record lows? So I want to start by giving you some background as to 2022 and as to what was going on around the period of 2022 that could have led to a sector, or that could have led to some of this coming out. So the first thing you have to understand, especially in 2020, going into 2022, is that the economy was under financial stress. We're in the heart of the pandemic, and we were having a banking sector where there were defaults just rising out of nowhere. Now, the cutoff rates for non-performing loans is 10%. The tolerable rate for the central bank is to see 10% of loans sitting at non-performing status. So what they don't want to do is juice the economy too much, that you start to have non-performing status of too many loans. So that means that they need to now start washing some of them out. So that 11.6% that you saw was of great concern to the central bank around the end of the year. And obviously, credit growth could not expand too much. The other thing that you are also seeing from the non-performing loan portfolio is that a lot of it has to do with government contractors. Government contractors who went and paid for a long period of time, who utilized government contracts to get loans from banks. But then, unfortunately, these loans stopped performing because the government was not paying them out. So domestic arrears that the government had with a lot of these contractors and suppliers that were not going paid were now creating a debt problem that was rising in the financial system, while the government itself needed to borrow heavily in order to be able to pay out or to manage itself or to just manage the pandemic as a whole. So that is some background information. So one of the things that had to get done in order to start paying off some of the suppliers is that issuance of bonds in private placements had to be done in order to help give liquidity to some of these suppliers, especially towards the end of 2020 going into 2021. So there was a huge issuance of government bonds during that period. And we're actually going to show you the data to support everything that is being said here. And I'm going to show you why we actually are in the situation of having record low non-performing loans and why we also have record high levels of government bonds. What we've actually come to figure out is these two things actually worked together. So let's go through this. So let's take a look at our non-performing loans in the government sector. As you can see, from 2019, this is the non-performing loan numbers in kwacha, in billions of kwacha. And as you can see, in 2019, it was at 3.2 billion, and it's been steadily rising. As soon as the pandemic started, you started to see this thing shooting up. Now, it was already rising because of the poor financial sector or the poor financial performance of our economy. Our economy was heading towards a recession already. So you can see that by now, September 2020, we were now sitting on non-performing loans of 5 billion kwacha. This was huge for our financial system. 5 billion kwacha worth of debt that was underperforming was really, really high for our economy. So if you can see it floating around 5.1 billion, all the way up to the first quarter of the beginning of 2021. So that's when it starts to come down, somewhere around March 2021. And as you can see, from about July or election month, there was a huge drop-off when it comes to non-performing loans. And some of this has to probably do with the way that contractors were being compensated to actually get out of this. So you can see from 2021 going all the way down until you get to about October or November 2021, when now you're sitting on only about 2.9 billion kwacha of non-performing loans. The first time it was lower than December 2019. So pre-pandemic levels, our non-performing loans drastically dropped, especially between June 2021 and November 2021. So this is quite important. Pay attention very closely because this explains why your banking sector has gotten very strong. And this is very similar to what's actually happening in the United States as well, and how central banks actually play a role in actually clearing out the mess. Now, here's something I want you to take a look at. From history, we have seen government bond stocks rising, but they were rising at a steady click. But from about 2015 to 2019, they were rising really strong. But something really strong happens, especially in long-term bonds issuance. So this is a breakdown of the stock of government bonds in billions of kwacha from 2007 onwards. I want you to pay attention to that period of 2019. If you take a look very closely of 2019, 2020, 2021, take a look at how much was issued or how much the bond stock grew from 2020 to 2021. This is that especially long bonds. Take a look at long bonds, which is the green bar. They grew from 49 billion at the end of 2020, and they had already doubled. So they went through 2 consecutive years of doubling. They doubled from 2019 to 2020 from 20 billion to 49 billion. Then they doubled again from 49 billion all the way to 96 billion. And as you can see, since then, they haven't really grown much. Even short bonds grew quite strongly from 25 to 38 to 52. They doubled from 2019 to 2021, and they just grew at a steady pace. So you can see from the end of 2021, there hasn't been a huge growth in bond stocks, but you can see that from 2020 to 2021, there was quite a significant growth in the bond stock. So that already affects now, from what you're seeing, coinciding with the year that you see non-performing loans drop, you see bond stocks double. So what people need to understand is in about 2020 going into 2021, half of the bonds in issuance, half of the bonds that are outstanding that the government owes in government bonds were issued in 12 months. Just about 40 to 50% were issued in just 12 months, especially the 12 months that came from quarter 2 2020 to quarter 2 2021. So that's just got to put that out there. Now, what you also look at is I want you to pay attention to secondary trading of government bonds. This is secondary bond trading. In other words, what was traded on the Lusaka Stock Exchange. Take a look at the huge spike that you're seeing in secondary bond trading in 2021. This is signals that there's a lot of activity happening in government bonds in the banking sector. Whenever you're seeing this secondary level of purchasing, it's happening in the banking sector. So that the growth was happening from the private placements and to secondary trading that was happening in the banking sector, because you saw a record 55 billion. This is the highest ever amount of bonds that were traded in the secondary market. 55 billion kwacha worth of bonds and 32 billion kwacha in 2022 on the secondary market. You saw that bond trading was spiking from 2017 and then in decline in 2020, but you're seeing 50 in 2021. You're seeing this huge amount. And then at the same time, you can pretty much see this step ladder going up of how much banks are holding in terms of government bonds. And you can see the biggest jumps. There were steady jumps that were going on from 2016 to 2017. That was fine. But the biggest jumps that took place were actually 2021 and 2022. So 2021, that was 100% growth. And if you look at it in growth rates, 2021 was 100% growth in the stock of the bond holdings of government bonds in terms of government bonds in the banking sector. So what was this? Okay. Now, to just kind of get out of this situation, one of the things that we all have to pay attention to in terms of what we were looking at here is that our bond stock, was actually being transitioned. So I want you to think very carefully about this. And a government contractor is owed money from a government that does not have cash to pay them. And this is where this comes from. The government did not have the cash to pay the government contractors. So the government contractors had to now get paid alternatively, and they've got bank debt. And the banks are starting to experience stress because the very contractors who the government is supposed to be paying are not being paid. So therefore, they're not able to service their loans. And you've got this growing amount of debt. So what is the only thing the government can do? Well, the government can't just print money from the central bank and just hand it to the government. That can't be done. What the government can do is issue something that is close to cash, a bond. and it can trade out that debt and give them a bond, something that you can take to a bank and you can trade. So where the government owed some of its contractors, it was able to issue these things out in terms of securities. And if you read some of the financials of the, not financials, the quarterly reports from the central bank that were coming out every MPC statement, you kept on hearing private placements had to be done to grow the government securities, and also it helped with monetary policy was money was being created in order to pay suppliers, especially for fuel and farmer inputs. So these were two of the major issues that were driving this. So you have government contractors who were not being served, who had to be served in order for the system to continue going. So government securities had to get issued to these people. So if I'm a contractor, I'm owed 5 million kwacha. I get issued a bond, which I can go to a bank and sell. Okay, I can sell that at my bank, or I can hold it and wait for it. And instead of the government owing me money, and having to look for cash to pay me next week or this year, they issue me a long-term bond. And that is why you're seeing long bonds. They managed to take what was owed to them in terms of debt and reform it into long bonds by trading out the what was due to these contractors for a long-term bond, which they could easily take to a bank and liquidate. And the bank was able to absorb it. This explains your secondary trading, because you had a bunch of government contractors who had to liquidate their bonds. Okay? You had a bunch of government contractors who had to liquidate newly issued bonds, which were now paid out in place of cash to a government that was bankrupt. I think you remember your president saying the treasury is empty. It's absolutely empty. And he wasn't joking when he was saying that. So you had an empty treasury, and therefore all you could do was start issuing out GSEC securities to be able to cover up this issue, or to deal with it. And also, now what starts to happen is, because the banks can then accept those bonds, issue out cash because they're flushed with cash at a time that the central bank has basically been pumping cash into them, they're now able to pay off. They're now able to just give out these people, or to square off this. And now they're holding a bunch of government securities instead of non-performing loans. So it was a swap. Okay. Now, you can't put this on our central bank. Even this was happening in America. Even in America, you found the Federal Reserve was actually buying out securities, securitized debt, which was sitting in bad debt. And as a result, if you go to America recently, when they did stress tests for the banks were doing brilliantly. Why? Because the Federal Reserve effectively bought out the debt of the bad debt that was sitting in these banks. And the same thing effectively happened. We managed to trade out the bad debt for government securities. So you're seeing banks with huge stocks of government securities. Just to get back here, you're seeing banks with huge stocks of government securities growing up here, like you're seeing going from 7 billion all the way to 25 billion. And then you're seeing non-performing loans coming down drastically from the highs of 5.1 billion sitting at 2.8 billion. And one simple graph just to show you this, here is the movement of government bonds, government bond growth from the banking sector, and non-performing loans from their banking sector. And take a look at the fact that they're moving in opposing directions. This is your strongest explanation of what happened between October 2020 and November 2021 that led to banks holding a lot of government bonds and led to non-performing loans drastically declining. You basically traded them out, and through mechanisms of the market. So this is what has strengthened the banking system and basically exploded our debt situation in terms of domestically. Because remember, we currently now have about 160 billion kwacha worth of government bonds in issue at the moment. And this is mainly because your banks were under stress, and they basically said, look, these guys are owed by you. So you effectively have to clean this out. Now, it's not that the banks went to the government and did this, but this was the way to keep the economy going and to basically keep things out. And this is why in quarter two, if everyone remembers, in quarter three and quarter two, you actually saw the economy grow quite strongly. Because, and this is what people meant when they said there was money in issue, there was currency in circulation. Well, this is your currency in circulation. Some of these contractors were now able to trade out. Some of them didn't owe the banks, so some of them were able to now trade out some of this debt to be able to, they were able to get those government securities. And instead of waiting for the government to pay them, which was becoming more and more unlikely, they now were able to go to the banks who were flushed with cash from the system to be able to pay them. So I hope this is actually something that we were able to explain as to why non-performing loans in the banks are doing so strongly, and why we've got record lows of only 5% non-performing loans coming out of a pandemic. Well, it's similar to the US situation. We washed it out using a lot of government securities, and we traded them out. So bank balance sheets are looking very strong, mainly because part of what was going on here, and there was strong non-performing loans even before then. There were high levels of non-performing loans at that period, but remember that it did get washed out. And just to revisit what we were talking about, we were saying even in 2019, your non-performing loan stock was very, very high during that period. Here we go. Even in 2019, you could see that your non-performing loan stock was still sitting around 8.9%. It was coming down from 2017, but it was still 8.9%, which was pretty high. And then it bounced back up to 11. So there was a lot of fragility in the financial system. So that's about that. I don't know if we can get Vernon back before we now start going into the final section of today, where we are talking about the wealth matrix by age. And for anybody, if you have questions or anything, please always feel free, throw us a comment or something that you'd like to share. But we want to get to the wealth matrix by age, and we were currently talking about being 20 years old, and what does your wealth status look like when you are 20 years old. By the way, that has been shared. It is an article that has been published out, and it was done by Analysis in collaboration with us and a few partners. But you can actually see that. You can actually see that article published out as to how exactly your non-performing loans are doing exactly what they're doing. Now, let's get into the wealth matrix for today and tomorrow. Please tune in tomorrow. We will be doing a full analysis of the payment systems and what that means for commerce. If you're an entrepreneur, you really want to pay attention to this, because it does affect how to interact with your customers and how to do business with them. Now, let's take a look at payment systems. Sorry, not payment system data, that is tomorrow. But let's take a look at the wealth matrix and how that is doing. Now, we were talking yesterday about the five levels of wealth that you do face. You face stability, where you are able to pay your bills. You pay strategy, where you are now able to make your payments. So where you're now able to deploy capital. Strategy is where you deploy capital. So stability is defensive. Strategy is offensive. Security is where you are somewhere between financial security and financial independence. That is now where you're not able to sweat things. You know that you can make your basic life. You've got enough assets to take care of your basic life. Freedom is somewhere between financial independence and financial freedom, where you are now able to do what you want. Your time is about what you want, not what you need. Okay, the thoughts of your time are now what you want and what you need. And wealth does affect that, people. And abundance is where money is no longer the main question. Sure, your lifestyle, sure, your experiences, but you're not really trying to trade between your life, between time and money. And that is what we're going to be focusing on today. And what does the life of a 20-year-old look like when they're looking at their life between those phases? So remember, we said when you're 20, you're dealing with your structural engineering phase. You're pouring concrete. And you need to understand that a little goes a long way. Now, when we were talking about stability, we were saying that you need to try and exit the pay-to-pay life. You need to make sure you build enough reserve and saving. You must exercise budgeting, but not just budgeting in terms of your income statement as a person. You must be also doing balance sheet. It is time to start getting accustomed with a quarterly net worth review, where you look at your assets and where you sit. You must make sure you run away from interest-bearing debt. Your financial ratios are your friends. It's a struggle to do it, but you're going to have to. Keeping your housing costs below 30% of your income, keeping your car payments, if you have any, below 8% of your income, and keeping your credit payments below 1% of your income, but maximum 5%. And you need to make sure that you exercise financial discipline, and you need to make sure that you do not try and go onto that post college celebration bender, where you think we are the ones. I've made it. I'm working, and the world needs to know that I'm working. Everyone needs to see my income. Otherwise, how will they know that I'm? How will they know that I'm doing well? How will they know that I got that nice job? You want to try and avoid that. So, in terms of building wealth, now let's go into the wealth building. So, that's the habit phase. Let's go into the wealth building side of being 20 to 29. So now, if you're talking about the army of money that you want to try and deploy onto the market, here's what you want to do. Your target amount that you're trying to get to is 20 to 25% when you are in your 20s. Okay. So now, if you're not able to, if saving has been a harsh habit for you, okay, start somewhere. We always say the word start where you are, do what you can, and use what you've got. Start where you are, do what you can, and use what you've got. And yeah, we will answer some of these questions towards the end. Start where you are, do what you can, and use what you've got. Now, part of what we can also see now is that we also start to see is one of the ways you can start is you can start by whatever age you are, minus 20, and that is the percent you can start. So if you're 25, save 5%, start there. Okay, if you're 26, save 6%. Just start there and gradually increase until you can get to 20% of your income. If saving has been a very hard habit for you, you're not going to become wealthy overnight, but just start somewhere. The other thing you want to do is push 50% of your pay raises towards improving your savings. So let's say you are earning 4,000 kwacha, and now this next year you're earning 5,000 kwacha. Well, instead of utilizing that extra 1,000 kwacha for spending, you need to now take that extra 500 into your savings, and that is your improved savings rate. So you can start with your age minus 20, and that's your starting percent. And every year you earn more money and push yourself to earn more money. What you want to try and do is push that half of that money into your savings. Your time with compound interest is your greatest weapon. Remember, your 20s have got your strongest money multiplier. So you want to try and use simple assets, very simple assets, to try and invest in. Unit trust can be your friend. Bonds are your friend. Things that you know can work very well before you try and show how complex you are. What often happens to younger people is because they've come out of college, especially those who've come out of college, is that they often want to show their education in their investing acumen. It is not the time to try and show how smart you are. Just go for the simplest things you can and get started simple. It's not something that you can easily brag about, but trust me, it's better to be able to brag about the lifestyle that you have in your 50s than the attempts of investment decisions you were trying to make in your 20s. So stick to simple things, get started simple and build the momentum, then diversify as you've built your momentum and start tracking your net worth. Okay? Now, when it comes to having fun, be cheap. Right, that's the best advice I can give you whenever you're younger. When it comes to advice, be cheap. When it comes to having fun, be cheap. Now, if you're talking about trying to build your financial security, you really have to get to your 20 to 25% savings and investment level and discipline yourself. Okay, so disciplined saving supports guilt-free discretionary spending. So what I often tell people is there's an investor budgeting script that you want to try and follow. And that means you flow your money by letting it come in through work, pay your taxes, tithes, and statutories. Then you come in and deal with your essential savings. So first do your essential savings like retirement and education if you got kids, retirement and your cash reserve. Then you do your essential spending, discretionary savings, discretionary spending, and you can waste your money away. If you know that you've already saved up your money and you've put it somewhere, you can waste it away. Now, if you're trying to get into financial freedom, you're not really going to get into financial freedom from age 20 to 29. I know people want to talk about it, but it's not that. So what you want to try and do is lay the foundations for you to get into your financial freedom, probably in your 40s. But laying the foundations is starting the savings and investment journey now. Know what it looks like. Understand what true financial freedom looks like. And when you're trying to get to a life of abundance, this is the problem with most young people, especially in our 20s. We've done this. I did this myself, is that you want to exude a life of abundance, and then you start going into credit. Don't fake it using credit. Okay, don't YOLO your life using credit, and don't not save so that you can show people what a life is like. Because a lot of people live that show life, and unfortunately, it will crack and it will break down at some specific point. So that's just some information I wanted to give you in terms of where you are, in terms of your 5 levels for your 20s. We're going to be going through the different ages of these. Now we're going to be talking about 30s. We're also going to be talking about 40s when you've mastered money. But the themes are the 30 to 39 is the building phase, 40 to 49 is the mastery phase, and 50 to 69 is what we call beyond the basics, when you are now beyond doing things in terms of the basics. And the following week, we'll be talking about what behaviors you need to try and deal with by age. And then finally, the following week after that, we'll be talking about money and marriage, what that means for couples, and what wealth is built like. We do have a question here that has to do with the story we're talking about from Bradley Kasongo. It says, hi, what's the connection between NPLs and government securities? Which loan stock are we referring to here? Is commercial banks to the Reserve Bank or bank customers, or to lend, bank customers to their bank lenders? Please elaborate. When we're talking about loan stock, the percentage of loan stock, we're talking about loan stock to companies and personal. We're talking about actual loans and advances that were given out, not loans between banks, not loans to not loans to the government. We're talking about loans themselves. So the percentage of loans that were non-performing, in other words, loans to businesses, loans to individuals, mortgages, personal loans, that stock of loans, those are the ones that only went down to a 5% non-performing loan according to the distribution of loans data that is issued by the central bank. So that's what we mean. Now, the connection between government securities and that is this actually quite simple. If I'm a government contractor and I haven't been paid and the government doesn't have the cash to pay me, and we're getting very close to a period where I won't be able to supply the next round of fertilizer or seed or anything, one of the things the government can do is issue me a security. Okay, a government security is a government debt note. Now, the beauty about a government security, and obviously through your central bank, the government can create them through a mechanism called private placements. So they can actually issue them instead of cash, because those things are tradable for cash. Okay. So the main connection here between the reduction of non-performing loans is the issuance of private placement government securities, specifically going to government contractors who are not being able to pay by the government. We're now able to take those securities and convert their non-performing loans into a government security. So you could basically go and write off your loan if the government issued you a security through the central bank. So a bond can be issued using these ISINs that were left over. So these are the things that they were able to do. And if you look at your bond stock, which I pointed out here, just quickly to show you, and I know that's a question that needs to be answered, just quickly to show you, if you look at your bond stock here between 2019, between the final ones, let me just get the comment out of the way here, Mr. Bradley, I apologize for that. But if you look at the bond stock between 2020 and 2021, one of the things you'll notice is that you'll see a huge spike. And if you go to the GRs, if you go to the statements, you will find that there were a lot of private placements issued. But this is something that will be published. You're free to ask questions. You can even come and write whenever we publish it. But we do have to close out the show, and we do have the return of Vernon to try and wind this up. Thank you very much, Vernon, and thank you very much to everyone who was with us today as we kind of dealt with that technically. All I was trying to tell you today is that bank balance sheets are stronger because bonds had to be issued.
Appreciate it. Thank you so much, Mutuale. You have yourself a fantastic day.
Thank you very much and have a good day.